Have you ever wondered why your credit score is what it is, or how you can improve it to unlock better financial opportunities? Your credit score is a key indicator of your financial health, and understanding it can open doors to favorable interest rates, loan terms, and even job prospects. In this video, we'll explore the factors that influence your credit score and provide practical tips and insights to help you enhance your financial standing and work your way toward achieving an excellent credit score. But first, let us discuss the different credit score ranges and what they mean for you. Understanding credit score ranges. Credit scores are like financial grades, showing lenders how well you handle your money. They range from 300 to 850, and higher scores open up better opportunities for loans and credit. If your score is below 580, it's considered poor. This range might make getting loans challenging, but it's a starting point for improvement. Scores from 580 to 669 are considered fair. You're doing better, but there's still room to grow. Lenders see you as a subprime borrower, so interest rates might be higher. Moving up, we have good scores ranging from 670 to 739. Here, you're in a comfortable spot. Lenders view you as dependable, which can lead to better loan terms. If you're between 740 and 799, you're very good. Congratulations, you're above average, and banks trust you more, meaning you'll likely get competitive interest rates. Finally, the pinnacle, excellent, with scores from 800 to 850. You're in the top tier. Lenders will offer you the best terms, and you might find doors open to you that others can't even knock on. If you're not in the excellent range yet, don't worry. Your credit score isn't set in stone. We'll share practical tips to help you climb up the credit score ladder and unlock the benefits of excellent credit. Keep watching to learn the factors that affect your credit score. Factors that affect your credit score. Payment history. Payment history is the most significant part of your credit score, accounting for 35%. Missed payments can really drag down your score. For instance, if you forget to pay your credit card bill, it can leave a negative mark on your credit report, making it harder to get credit in the future. Make it a top priority to pay your bills on time, every time. Set reminders or automate your payments to avoid any slips. Your payment history can take a hit if you're consistently late, but it can also improve over time with a consistent record of on-time payments. Credit utilization. Credit utilization, which makes up 30% of your credit score, is all about how much credit you're using compared to your total available credit. For example, using $2,000 of your $10,000 credit limit equals a 20% utilization rate. A lower utilization ratio is better for your credit score. A helpful tip here is to keep old credit cards open to maintain a larger total credit limit, reducing your overall utilization percentage. Use these cards lightly but regularly, perhaps for a small subscription or recurring bill, to keep them active without racking up debt. Length of credit history. The length of your credit history accounts for 15% of your credit score. This factor evaluates how long you've been using credit accounts, such as credit cards and loans, to gauge your credit worthiness. Someone with 10 years of credit history might be seen as more stable than those with just 1 year. If you're just starting out with credit, you might have a lower score here, but don't worry. As time goes on and you build a solid history, your score will naturally improve. It's important to start building your credit history as soon as possible to ensure a strong financial foundation for the future.
By the way, if you like this type of content, be sure to hit the like and subscribe button.
Credit mix. Having a mix of different types of credit, like a mortgage, auto loans, and credit cards, can positively affect your score. It shows you can handle various credit responsibilities. However, while it contributes 10% to your credit score, keep in mind that you don't need to go out and apply for different types of credit just for the sake of improving your score. Don't rush to open new credit accounts unless they serve a genuine financial purpose. New credit. New credit makes up the remaining 10% of your credit score. When you apply for a new loan or credit card, the lender typically performs a credit inquiry to assess your creditworthiness. There are two types of inquiries: hard and soft inquiries. Hard inquiries can temporarily lower your credit score and remain on your credit report for 2 years. To minimize the impact on your credit score, be strategic when applying for new credit. If you plan to make multiple credit inquiries, do them within a short time frame, usually within 2 weeks. That way, they'll count as a single inquiry, reducing the potential negative effect on your credit score. Avoid unnecessary credit applications and inquiries to maintain a healthy credit profile. Those are the key factors that affect your credit score, as well as some tips you can follow to build and maintain an excellent credit score. Remember, it's all about responsible financial management, paying your bills on time, and using credit wisely. What strategies have you used to improve your credit score, or what challenges have you faced in managing it?
Show your support for more content like this by hitting the like button, dropping a comment, and subscribing to our channel. It's a great way to assist us in assisting others. Now that you have finished this video, you absolutely want to watch this next video.